Hi everybody. We're back online. It's been quite a while since we've done a live video. There, to be quite honest, 2020 happened and we have been swamped. So life's starting to finally get a little back to normal. So we hope to be able to do these live videos a little more frequently, but we'll have to see how it goes. We are DeCarly Trading. We are a futures and options brokerage service located in Las Vegas, Nevada. So we're going to talk about trading. We're going to talk about the financial markets today, but with a focus on the futures markets or the futures side of things, not stocks, because again, we are futures brokers. Just want to make sure everybody understands we are talking about active trading. It's speculating. It's not suitable for most people. There's a substantial amount of risk involved. So we're going to take a look at some live charts here. This is a chart of the E-mini S&P, specifically the daily chart. And from this view, it looks relatively reasonable that the S&P is grinding its way higher. In our opinion, the S&P, or at least our models, our technical models, the S&P has about a 75–80% chance of finding at least some sort of high. It might be just temporary, but some sort of high between 35.50 and 38.50 and 38.85. The market's been moving so quickly, it's hard to keep up with the handles. We get these levels from a couple of things. There's some volatility numbers we're looking at. Also, it's trend line resistance. Also, the RSI and other oscillators are starting to get a little overbought. In our opinion, things are highly frothy, highly speculative up here. That doesn't mean the market has to turn around. It certainly doesn't. Ultimately, it boils down to how many buyers and sellers you have. And at this moment, we have more buyers than sellers. But what I want to point out is the monthly chart. Now, the monthly chart tells a different picture. What appeared to be rational buying now might actually look irrational. And in our opinion, this is irrational exuberance. We've been in this megaphone technical pattern for the last couple of years. Started when it peaked out in 2018. We put a crosshairs up here. So in 2018, we peaked out, and that was kind of the starting of the pattern. We've reached the upside on a couple other occasions. This is our third, and we've traded at the bottom end of the pattern a couple of times. I do not believe we're going to return to the bottom of this pattern. If we did, we're talking under 2000. I don't think that's going to happen, and at least I really hope not. If we do, then we're in big trouble. That would be pretty ugly. But I do think that we could eventually see some sort of test of this uptrend line. Now, uptrend lines change, volatility changes, circumstances changes. So this is not a science, it is an art. This correction could be 3,000, it could be 2,700, it might only be 3,200. It just kind of depends on how things go. There is a trend line we're looking at here. It's an internal trend line that would put us right around 31 to 3,200 on a correction. So I'm not saying bet the farm and sell everything. Absolutely not. I'm saying just be woke, pay attention to what's going on. This time of year is prone to big corrections, especially after an election year. The month of February is generally pretty rocky, particularly if the incumbent loses. So all of those things are setting up for what could be a decent sized correction, so just be aware. Now, before we talk about Treasuries, I also want to point out, this is a monthly chart of the Nasdaq. You know what? I forgot to mention one thing in the S&P, sorry. One thing that we're really interested in paying attention to is the divergence. You can see here that as the market's been making new highs and testing the upper end of this trading range, the RSI, which is the relative strength index, which tells us how much momentum is behind the move and whether or not the market's overbought, so on and so forth, it's making lower highs. Again, these are just tools. There's no guarantees that that means we're on the step of a big correction, but the odds are we probably are. That's generally what happens when you see that sort of divergence happening. Okay, going back to the Nasdaq, I'm not going to spend too much time on the Nasdaq. To be honest, our models really don't work well on the Nasdaq. Just it's the nature of the price action. It's such a feast or famine and emotional market. It just tends to not pay attention to some of the charting rules that we use. So I don't focus on it that much, but I do think this is worth taking a look at. This is an incredible chart. You can see how quiet the Nasdaq was for years and years and years. Specifically from, we're looking, this goes all the way back to 2006, and it really did a whole bunch of nothing for quite a while. And then suddenly we get this massive explosion, most of which has occurred just in the last handful of months since the March lows. And this might be eye-popping to you as well. If somebody that bought one single futures contract near the March low and happened to roll it over and hang on to it until today, might be up somewhere between $120,000 and $135,000, depending on rollover costs and timing and that sort of thing, but just gives you an idea. That's one contract. You can see in the past, let's go from like the 2008 low. It would have taken 10 years to do the same. We've done it in less than a year, from March to now. So these are really incredible times. This is not something that you see very often. We may never see something like this again in our lifetime, to be quite frank. So it's important to take a step back and just see where things are on a historical scale and just how realistic that a continuation of this is or isn't. In my opinion, it isn't, but time will tell. So let's focus back on the 10-year note. The conventional wisdom suggests that Treasuries have topped out. We had a huge run last year in the March to summer time frame on the coronavirus fallout and that sort of thing. Treasury spiked and they really never gave anything back. So this is the exact opposite of what we saw in stocks, right? In stocks, they sold off in March, well, February and March, and then they came roaring back and haven't stopped since. Treasuries adjusted to the new coronavirus world immediately. That's what we see in this big spike here, but never actually reverted back. And so that's interesting to me. And also I've noticed that this appears to be more of a continuation pattern than a topping pattern. I mean, we do see that the RSI is rolling over, but when I look at that, I notice it actually did the same thing last year, right here. It started to roll over. It looked like the market was putting in a top, interest rates were going higher, and we got the exact opposite. I'm wondering if this year's not just simply a repeat of that. You've noticed putting in a trading pattern here, it's a channel. We've held the bottom into that channel. If that bottom continues to hold, which is, if you're following the 10-year note, it's somewhere around 135 and a half, 136, depending on which contract month you're looking at. If that general area holds, I think we have another leg up. In fact, I think we could see the 142, 145 range. I'm not sure I would love to see that because that means that there's definitely some interesting and not favorable things going on in our economy. For example, if we rallied to 145, that would probably put interest rates on the 10-year note close to zero, which is probably not something that I would prefer to see, but it is what it is. These are strange times we're living in. So another thing that we are watching is the US dollar. Now, the 10-year note and the US dollar are correlated. Recently, they've been correlated about 60% of the time, meaning if the dollar's up, the 10-year note is up about 60% of the time and vice versa. So if we're right about treasuries, and if we're right about the dollar bottoming out, which I believe we are, they should kind of move together. In other words, the dollar and treasuries can move up together. This is a little counter to what some people believe is conventional wisdom, but the reality is the relationship between those two contracts have altered quite a bit over the last couple of years, and they've actually gone from positive to negative correlations, so it's interesting. But at the moment, I think they are positive at the moment, and I think that actually strengthens as we go into the later part of the year. So in the dollar, the key number we're looking for in the dollar is about 88. As long as the dollar holds above 88, which is the blue line that you see here, should make our way into the mid-90s and maybe even the 100s again. That's not out of the question. central bank policymakers and the government, obviously they're printing money. There's obviously that sort of thing going on that people believe will diminish the value of the dollar. But let's face it, other countries are doing the exact same thing. Maybe not quite to the extent we are, but we have outperformed in regards to GDP, and we're also winning the battle when it comes to interest rate differentials. So in my opinion, I think the weak dollar is probably last year's story, and things change as we go into 2021. One other market that we have our eye on is crude oil. And crude oil has benefited quite a bit from a weaker dollar. But again, if the dollar turns around, that will work against crude oil with all else being equal. Even if, in other words, if supply demand fundamentals stay exactly the same and nothing else changes, just the dollar going up alone will put crude oil back in the 30s, which is this trend line here. I'm not convinced that we'll get all the way down to the 30s, but I wouldn't be shocked to see the low 40s. So if in that situation, we'd see a move to about the middle of this trend line. The resistance we're looking at is about 54, 55. In addition to fundamental issues, I mean, demand destruction has been the story for 2020. It really hasn't come back despite this big run up in crude oil. But we're coming up against the downtrend line resistance and also the previous support, which is this line that we've got drawn right here, now becomes resistance. And both of those points coincidentally come in around $55 a barrel. So it's going to be really tough for oil to break above that, at least for now. I think eventually we will. I won't be surprised to see $70, $80 crude at some point much later down the road. But for now, there should be a pretty good ceiling there. And I think this pushes us back into the 40s. Now, of course, these are all opinions, and eventually the market will either prove us right or wrong. So these are just things that we're looking at. We're not trying to change anybody's mind. If you're on the other side of the trade, good for you. You're probably doing well. But the point of this video is to just open your eyes to the idea that sometimes trends don't last forever. What we've seen in the last couple of months has obviously been well-defined trends in most of the markets, but that doesn't mean that as we go forward, that's going to be the case. And in fact, this is the time of year where you're more often to see, or you're more likely to see trend reversals. So just be on your toes. Again, we're a commodity futures and options brokerage service. We're in Las Vegas, Nevada. You can visit our website, decarlitrading.com, if you're interested in learning more about us or learning more about trading. There's several articles and videos on the website. And we have a new book that we released last year. It's called Trading Commodity Options with Creativity. And in this book, we cover over a dozen strategies in commodities that include option spreads, outright options, trading options versus futures, that sort of thing. Because the one thing that I have noticed over the years is most people lose trading commodities because of leverage and because they simply run out of money if they're wrong. They're trading too heavily, they're trading too many contracts, they don't have enough margin. But trading with options can eliminate a lot of those issues that traders have trading futures. So hopefully if you're interested, you can check that book out. If you're not so interested in options, but you're still like the idea of trading commodities, higher probability commodity trading, we just re-released it in paperback. So it's only $20 and it's a great buy at $20. So we hope to hear from you soon. If there's anything we can do for you, let us know. decarlitrading.com.